I'm John Hanna with CDTV.net in New York, and we are here at the Cipriani Wall Street with Hank Smith, the Chief Investment Officer for Haverford Trust, coming in from
Philadelphia.
Thanks for taking the train to come up and meet us, sir.
It's a pleasure to be here with you, John.
Now, sir, tell us a little bit about Haverford Trust.
Sure. We've been an investment management firm founded in 1979, consistently using the same investment philosophy, which really is a quality approach to investing both on the equity and the fixed income markets. And on the equity side, we tend to favor large established companies that have a consistent track record and who share these characteristics: A-rated balance sheets, so we want good financial strength, consistency and predictability of earnings, and payment of a dividend, but with more emphasis on companies that grow their dividends based on earnings growth. So in our view, the increase of a dividend is one of, if not the most tangible confirmations a board of directors and management can make about the current state and future of their company. On the fixed income side, we favor quality investments in the intermediate and short-term sector.
Okay, now, can you talk about your returns in the past 5 years on your funds?
Sure. We've have had a positive annualized rate of return in about the 2% range over the past 5 years. Obviously, no one was immune from the bear market in late '08 and early '09, and that includes us, particularly given one of the tenets of our investment philosophy, and that is to stay fully invested. So, yes, we did not lighten up and go to cash in October or November of 2008, but very importantly, that also meant we were fully invested at the bottom of the market in March of '09. So we've been able to capture almost all of the upside since March of '09. The S&P is up approximately 81%, and our equity returns are up about 76%. But during the bear market, the quality approach to investing certainly helped buffer the downside. Our portfolios were off about 25% in 2008 versus 37% for the S&P.
With regards to the type of investors within your company, what kind of investors do you have in your company?
Sure. Today we're running about $6.5 billion, and about 70% of that is private client, high net worth investors, and 30% institutional investors. And the institutional investors take on the character of being nonprofits, endowments, religious organizations, hospitals, as opposed to pension funds. We also do have some state money, but it's primarily in the endowment world.
Okay, so right now, you were able to ride the upswing of the market. Are you fully invested right now?
We are fully invested right now. So let's talk a little bit about strategies and how we see the market today and some of the things that we're doing. I'll go back to the beginning of 2009, and our macro view then was that enough monetary stimulus had been applied that it was reasonable to expect at some point we would see the end of the recession and the beginning of a new expansion. And given that, we wanted to position the portfolio to have a little bit more economic exposure, a little bit more cyclical exposure. So we added names in the basic material and industrial sectors, names like Air Products and DuPont in basic materials, and industrials, names like Caterpillar Tractor, Eaton Corporation, United Technology, We also added Union Pacific in the transportation sector. Those moves have very much benefited the portfolio, and we've kept our exposure there. Right now, today, we look at the portfolio as really being barbelled between the cyclical exposure that I just talked about, and on the other end, the steady eddies, companies whose earnings are not going to be as impacted as to whether the economy is growing at 2% or 4%. So those would be names like Johnson & Johnson and Procter & Gamble, Pepsi, Coke, McDonald's, Walmart. So that is the one end of the portfolio, and having some of the cyclical exposure is the other side. As we look forward, we've had tremendous moves in some of these more cyclical names. We've had a triple in Caterpillar, a triple in Eaton, and we'll probably be looking to take some of that off of the table. I'm not sure we're going to sell those names, but I think we'll certainly take some profits. You're never going to call the top of the market, but they are called cyclicals for a reason. They do have a lot more volatility because of their exposure to the economy. But one thing that has kept them going is that they have exposure to emerging markets, and that is a trend we're very aware of, and one that we pay attention to with respect to our portfolios.
Okay, now that you mentioned emerging market and overseas exposure, what do you think of the recent crisis, or well, it's not yet a crisis, but recent talks of Ireland defaulting or looking for a bailout?
Well, it's certainly this has been haunting the equity market since the spring of this year, and we finally had our first correction after about 15 months, and a lot of that had to do with fears of defaults in Europe and banking contagion in Europe, and I believe also the flash crash in May took away a lot of investor confidence. And so Europe as an issue seems to come and go, and right now it has come back to the forefront. We think that the developed international economies are a slow growth area, as the United States is, and that is why we're emphasizing at the margin companies with emerging market exposure, because that is, at least over the next 3 to 5 years, where faster rates of growth are going to occur. But John, the fact is, our economy and Europe, we're going to continue to experience slow growth for, if no other reason, the fact that we are under the cloud of deleveraging. Both the consumer is deleveraging and the financial system is deleveraging. And so regardless of monetary or fiscal policy, growth is going to be slower than it should be. Our view is that this is not a long-term problem, but rather something that's probably going to play out for another 2, 3, possibly 4 more years. But we're not looking at a lost decade. In our view, we're not looking at a situation like Japan has experienced.
Okay, now that you mentioned Japan, everybody's talking about Japan kind of similarities with regards to the Fed moves and all that stuff. So you don't see that?
Well, no. We've addressed our problems much quicker than Japan did. In Japan, you still have zombie banks that have bad real estate loans that go back over 20 years. The one thing we do here is we address those problems. We write them off, recapitalize, and move forward. We did this in the very early 90s with the savings and loan crisis that resulted in the Resolution Trust Company, and we've done this now with TARP, which while a lot of people have disagreed with, TARP was highly effective. It prevented a complete collapse of the financial system, both here and globally, and most of the banks have paid back their TARP money with interest, and from the standpoint of that portion of TARP that went to the banking industry, the United States government has made money. So it can only be viewed as very successful.
Okay, now let's go back to your strategies. What do you look for in a stock? Let's say, for example, you have an open slate, you have nothing on your desk right now. This is just an example. What do you look for first in a company?
Sure. So again, we favor companies that one, that are large and established companies that have a track record, so that we can see how they've done throughout previous cycles. We want to know, there's an expression, John, that success begets success. So we're not looking at startup companies, at small cap or micro cap companies, where admittedly there might be very attractive returns, but the risks are much higher. So from our standpoint, we're really trying to control risk. We want companies with A ratings, so there's the financial strength is not in question. And again, then we favor companies who have a record of consistently and predictably growing, that grow their earnings. And then the final key is, at any point in time, you don't want to have to pay too much for those earnings. So yes, we do pay attention to valuations. You can have a great growth company, but if you are paying too much, you might see a stock price that either goes nowhere or declines as the valuation gets compressed. And certainly there are plenty of examples of that in today's landscape.
Any other things you might want to add?
Certainly, playing on that theme, a lot of people have correctly pointed out that we've experienced a lost decade as equity investors. The fact that over the past 10 years, the broad markets have provided a negative annualized rate of return. That is a pretty rare event. But it was not a lost decade with respect to fundamentals. You saw tremendous earnings growth confirmed by dividend growth in at least our universe of companies. So what has changed between today and 10 years ago is today, because of the growth in earnings, the decline in the stock prices, you have very, very attractive valuations. In fact, we would say the market right now is as attractively priced as it's been in 25 years, with PEs at about 12 times next year's earnings. You've got to go back to the mid-'80s when you saw PEs that low. And given the low levels of inflation and the low levels of interest rates, I think it's fair to say that the stock market is cheap today.
That's Hank Smith, Chief Investment Officer for Haverford Trust, joining CDTV.net at Cipriani Wall Street for the On Location segment. Thank you.
Thank you, John. Nice to be here.